is president of RGB Capital, where he manages personal and client portfolios. He's also president of the San Diego chapter for AAII. Today, Rob will be talking about how to create a low volatility portfolio when interest rates are rising. We are coming out of a multi-year bull market where bond prices have increased as yields have declined. Today, expectations of a rising rate environment are creating headwinds for typical low volatility bond investments. Today, Rob will show how to leverage the relative strength relationships to identify funds that are still trending up in a rising rate environment. His presentation will include a discussion on how to identify low volatility funds and how to create a portfolio that matches your tolerance for risk. A little bit about Rob. Prior to founding RGB Capital in 2009, Rob was a consultant with Deloitte and a chief information officer for a real estate company. Rob holds a BA and MBA degrees, is a registered investment advisor, and a retired CPA. And now a personal factoid about Rob. Rob and his family are active scuba divers. Rob has dove all over the world, including the Caribbean, Mexico, Asia, and Australia. And he proposed to his wife 30 feet underwater in La Paz, Mexico. That's a cute story. And I visualize that when I talk about it. Anyway, ladies and gentlemen, join me in welcoming Rob Bernstein. Using this clicker for the slides?
I think so.
Okay.
Yeah. Thank you, Fred. Can you all hear me? Is this mic working?
Yes.
Great. Well, thanks for having me up here this morning. It's such an honor to be here. Now, with today's presentation, I attend a lot of investment meetings, presentations like I assume you guys do. You're here today. And my goal is to hopefully share with you a few nuggets of information, a few ideas that you can take back with you to your home and take advantage of to tweak your investment approach or the way you select investments. I'm not here to try to change the way you approach investing. So success today for me is if you guys all walk out of here with just a few nuggets of information that say, hey, you know what, let me think about that. Let me see how I can apply that to my own investing world. So with that, I started out this morning, I got up, the alarm went off just on time, got up, had breakfast, got in the car, headed up here, and I was about 20 minutes outside of my house, and oh my gosh, I forgot something. And I had everything set up on my desk. All I had to do is pick it up and walk out. My keys, my wallet, my phone, and a stack of papers. Of course, I left the stack of papers at home. But modern technology is great. I stopped by a Kinko's and had them print these out, and I still made it here on time. It was pretty amazing. So the reason I bring that up is there's a form here. If you want a copy of today's presentation, unfortunately, due to compliance reasons, I am not allowed to have Fred posted onto the website, but if you want a copy of the presentation, I'm more than glad to share that with you. Just please give me your name, your email address. Please write as neatly as possible, and I will get you a copy of that. Also on here is an invitation if you want to subscribe. I publish a newsletter, a weekly one-page newsletter if you don't already receive it. I know a lot of you already do. Just check that box, and then I'm also having a meeting up in Culver City, an RGB Capital Group meeting on the 29th of September. If you're any interested in learning what I do, feel free to attend that as well. But anyways, there's a few here. There's several up on the table. Just fill them out and leave them on the table. Okay. With that, Fred did a pretty good job of introducing myself, but I want to touch on a few things because it gives a little bit of kind of flavor and background of where I come and how I look at the markets. As Fred said, I run RGB Capital Group. I opened my doors in 2009. And many people think, wow, that's an interesting time to open an investment advisory business. But it really has to do with how I look at the market, and why that makes sense is that during the financial crisis, I was managing money. I was working actually for Newland Communities, a real estate company, great place to work in 2008, huh? And I was doing my investing during the evenings and during weekends. And when the financial crisis happened, we had a good story to tell. I was investing for myself and my family, in particular my mom. And we got through that with our capital still intact, which is pretty powerful, because if you can get through that with your capital intact, you can deploy that once the market bottoms and starts to go back up. I was sitting around talking with my mom. A lot of her friends and even my friends couldn't retire when they wanted to, had to go back to work after retiring, or change the quality of their lives. So these are big life decisions. And so I thought I could add a lot of value to individuals by helping them with their investments. And so that's why I started RGB Capital Group at that time. Obviously, it wasn't a great place to be in the real estate business, so we parted ways. And prior to that, I was at Deloitte, actually up here in Los Angeles for almost 11 years. I'm also active in the industry. I'm a board member of the National Association of Active Investment Managers, which is a group of investment managers that don't necessarily subscribe to the buy and hold approach. And then, as Fred said, I'm the president of the San Diego chapter. And I just want to give the LA chapter a lot of thanks. I started the chapter about 5 years ago, and the LA chapter really gave me a lot of support. Particular thanks to Don Gimbel. He was tremendous in his support to help us get going. Quite a man. And then also, I don't know if Jim Quinn is here today. He's also been very helpful in helping us out as well. So just thanks to your chapter. You guys have been really, really helpful. So let's start with, let's get into the presentation. This is a chart of the 10-year Treasury yield. It goes all the way back to 1962. You can see Treasury yields peaked here in September of 1981 at 15.8%. Quite high when we compare it to current yields, which are, I think they closed yesterday just under 3%. Yields dropped for over 30 years down to 1.46% in July of 2016. This created a great opportunity for investors, particularly conservative investors who wanted to manage risk. As these bond yields declined, we all know, right, bond prices started to rise. And this was just a great opportunity, maybe a once-in-a-lifetime opportunity for investors to get access to a low volatility investment, whether it be treasury bonds or other types of bonds, and take advantage of that dropping yield. Now you can see here, yields have kind of bottomed. They're still extremely low at about 3% compared to historical standards. If you listen to a lot of the experts and analysts, they say we need to be prepared for a rising interest rate environment. That may be the case. I don't see it quite yet. Certainly they've risen a little bit, but they're only back to levels that we last saw in 2014. I think the Fed is certainly focused on raising interest rates. At the short end of the curve, that's where they control the interest rates, but the market really hasn't moved along with that. So we got a yield curve that's really flattening out. The Fed's raising short-term interest rates, but long-term interest rates really aren't moving too much. So time will tell whether we're in a rising interest rate environment. But regardless of whether or not we are or not, we could probably all agree there's probably not a great opportunity in the bond world going forward. Interest rates are pretty low. If we hit another financial crisis or a recession of some sort, they could probably drop down a little bit, but there's not a lot of downside on the yields, meaning there's not a lot of upside for our bond and other income type investments. So the question is, what do we do in this type of environment? If we think either we're going to be in a rising interest rate environment, or if bond yields are just going to go flat, what do we do to manage risk in our portfolio without the option of using bonds? So that's what we're going to talk about today. And so to start that out, I think we need to have a common understanding of what is risk. And so let's talk about risk. So the first part of this presentation, I'm going to talk about what is risk and how do we measure risk. Here's some guy hanging from a cliff. That looks pretty risky to me. hopefully he's got the training to mitigate some of that risk away, but what is the risk here? The risk is that he doesn't come off this side of this cliff successfully, right? There's some uncertainty whether or not he will make it off this cliff. I'm not sure if he's trying to go up or down, but there's certainly some uncertainty what the outcome of that little endeavor will be. This guy, this little mouse here, what's his goal? His goal is to get to this piece of cheese, right? Without getting squashed by the mousetrap. Now, he's mitigated some of his risk away by donning a helmet. I'm not sure how much that's going to do for him, but there's certainly some uncertainty surrounding the successful outcome of getting access to that cheese. Now, all fun and games, there's also risk when we talk about our investment portfolios. Certainly, there's uncertainty as to whether our portfolios will be profitable, whether the trades that we place in our portfolios will be successful, or will they result in a loss. And so the way I look at risk and define risk is that it is the level of uncertainty associated with a desired outcome, right? So if this was me hanging off here, it'd be a high risk because the level of uncertainty around a successful outcome there would be very, very small. So what we want to do is how do we measure that risk? We're going to talk about how do we measure that risk as it relates to our investment portfolios. So here's two lines. The red line is the S&P 500. I think it's the SPY, it's the ETF that tracks the S&P 500. And the green line is a floating rate bond fund. This chart is for the year 2016. They both start at the same place, and they both end at about the same place. They both produced about a 12% return over that year. Just curious, out of show of hands, who would prefer to be on the green line? Anyone prefer to be on the red line? Okay, one. Okay. So most investors, and I think you've kind of proved that with this data set here, is most investors would prefer to be on the green line than the red line, given that all else is being equal. Anyone want to share why they would prefer to be on the green line versus the red line? Anyone willing to?
Consistency.
Less volatility.
Yeah.
Stability.
Okay. So I heard less stability, less volatility.
Less emotional stress.
Yeah.
Less emotional stress. That's all, I agree with all of that. And to me, there's more certainty. If we go back to our definition of risk, there's more certainty in the green line than there is the red line. If we went back to this time period here, it was dropping, it came back up. At this point here, we don't know if it's going to continue to go up or go down. Whereas if we were in the green line, we would have more certainty that if the market was to go down, our portfolio or our investment wouldn't go down that dramatically. So it has to do with the level of certainty that we have in the future outcome of our investment. Now, as investors, we like to measure and quantify things. And so one way to measure risk is actually we measure volatility, which implies risk. And one measurement that is often used is standard deviation. And you can see the standard deviation of the green line is 0.6, and the standard deviation of the red line is 3.77. So what we see visually as a lower volatility investment is actually quantified. We can see that in the quantification of that as well. And this is a very common measure of risk or volatility.
Excuse me, the green line, the red line being the SPY, what would the investment have been that represents the green line?
The green line is a floating rate bond mutual fund.
And what would that symbol have been?
That symbol's right there. It's BXFIX. And again, if you can't see all that, and again, if you want a copy of the presentation, all that will be in there for you. Okay? And I didn't mention this earlier, but please feel free to, if you have questions during the presentation, I'd rather take them as we go through. So while it's top of mind, we can answer and address those questions. So there are some limitations to the metric of standard deviation. And one of those limitations happens to be that it doesn't give us any sense of the strength of return. So I've got 3 lines here. There's a 25% constant return line, a 10% constant return line, and a minus 10% constant return line. Now this is a log chart, so those constant return lines are plotted as a straight line. And you'll notice they each have a standard deviation of 0. So standard deviation gives us no indication as to the strength of the trend. Right? And why is this standard deviation 0? Well, actually, you know what? Let me go back here. I failed to really describe what standard deviation is. So standard deviation really is the variation of returns over a given time period. So you can see the variation of returns of this red line they're much more dispersed than this green line. So the tighter the line is to a straight line, the lower the volatility or the lower the standard deviation will be. So when we look at these constant return lines, the standard deviation is 0 because there is no variability to that return. Every day we know we're going to get a small increment of that, say, 25% return each day. There's no concern about it dropping or going up higher on any given day. So that variability or standard deviation is 0. The other limitation of standard deviation is it doesn't give us any sense of upside volatility or downside volatility. Right? So the 2 lines here, I have a Ridex Electronics sector fund in red, and the green line is the Ridex Precious Metals Fund. They both have a standard deviation of about 7% for this time period shown, which happens to be year-to-date 2018. But as you can obviously visually see, the red line produced a positive return, and the green line had a negative return. So standard deviation doesn't give us any indication as to upside volatility or downside volatility. So because of these limitations, it's useful to put standard deviation in context of something else. And that something else is typically annualized returns. So this is a risk-reward chart. I'm sure many of you have seen this type of chart before. We have standard deviation plotted on the x-axis, and we have annualized return plotted on the y-axis. We've got higher risk to the right side, lower risk on the left, and lower to higher annualized returns. On this chart, I've plotted a few data points. I've plotted a money market. It's a Vanguard money market, the Vanguard Total Bond Fund, to give you a sense of investments at the lower end of the scale. And then I've plotted 4 of the major indices, the New York Stock Exchange Composite Index, the S&P, the Russell 2000 Small Cap Index, and the NASDAQ. And then I've plotted this regression line. And this regression line is just a line that is an equal fit to the data points that are present on this chart. And the reason I put that up there is to give us a visual sense of the trade-off between risk and return. So you can see the further we move down the risk scale, investors would expect, there's no guarantee, but they would expect over longer periods of time that they're going to get a higher return. Now, as you can see, investments don't always fall directly on that line. So I've plotted 2 parallel dashed lines here. This is what I call the long-term expected return channel. So if you were to take an investment that had a volatility metric down here, you would expect to get maybe between 2 and 6% return. If you were to take an investment down here, closer to the 5 level, you might expect a return between 6 and 10%. So generally, investments are going to fall within this general range. Now, as investors, we typically like low volatility. You all said you like the green line over the red line, right? And we also like returns. And so our goal as investors is to try to achieve what we call better risk-adjusted returns. Better risk-adjusted returns could be returns that are up here, but they could also be returns, let's say we have the S&P 500. If I could get the return of the S&P 500, but at a volatility down here, that would also be considered a better risk-adjusted return. So that's our goal, is how do we create portfolios that provide better risk-adjusted returns? It allows us to sleep better at night. We don't get as anxious when the market gets a little wonky. And it just provides a better overall investment experience. Now, as investors, we have the opportunity to control risk, but we don't have the opportunity to control return. And what I mean by that is, we have the choice. I could put 100% of my portfolio in a money market, or I could put 100% into the NASDAQ, right? Two ends of the scale. Or I could do something in between. I could create a portfolio that has a risk profile between those two. Now, at any given time, you have no control over the returns that the market gives. Sometimes it gives returns, sometimes it takes them away. So just because the S&P is, over this time period return looks like a little less than 8%, for any given time period, that may be a positive number or a negative number. And so this is an important point, I'll just reiterate, we have all the control over how much risk we take. We have no control over how much return we receive. Make sense? The nods? Okay. So as I mentioned, standard deviation doesn't provide a lot of information about upside volatility and downside volatility. As investors, we certainly prefer upside volatility. That typically means that our investments are going up, and we're more concerned about downside volatility. So I like to focus on metrics that are focused on downside volatility. One of those is drawdown, or it's also called retracement. And all drawdown is the percentage price decline from a peak to a trough before it bounces and exceeds the previous peak. All right, so it's a percentage price decline from a peak to a trough before it bounces and exceeds the previous peak. So, for example, we have a very small drawdown here. It peaked, it dropped 0.21%, bounced, and went back up. Here was another drawdown. This is a 0.25% drawdown. The term maximum drawdown refers to the largest percentage price decline for a given period of time. So in this small window here, this was a 2-month window, the maximum drawdown for this particular investment was 4.95% from this peak to this trough before it bounced and exceeded. So that's a useful piece of information to know. For example, some drawdowns that you might be familiar with was the S&P 500. It fell 56% during the bear market during the financial crisis. That was a pretty significant drawdown. The one thing a drawdown doesn't tell us, though, is it doesn't tell us the duration, the length of time that that drawdown was in place. Was it a couple of days like this? Was it a couple of weeks? Or was it several years, 5 or 6 years, as in the case of the S&P 500 during the bear market? So drawdown doesn't give us any indication of that duration. So that's where I like to use a metric called the Ulcer Index. Anyone familiar with the Ulcer Index? Well, a few people, good. The Ulcer Index was developed by a gentleman by the name of Peter Martin. He first published it in his book called The Investor's Guide to Fidelity Mutual Funds. I think it was back in the 70s. But the Ulcer Index measures both depth and duration of drawdowns. And so you've got both components. You've got how deep it was and how long it lasted. And the lower the value, the UI value, represents a lower volatility investment. So the higher the UI value, the more painful it, like an ulcer, might be. Now, I don't have time in our limited time today, to go through all the details of how that's calculated. But if you're interested, I invite you to check out my website. There's a resources tab. And I've put up a UI UPI, which is the Ulster Index and Ulster Performance Index guide. So if you're interested in looking more into it, it'll be a great guide to get you there. The Ulster Performance Index is a measure of risk-adjusted return. So the Ulster Index doesn't give us any indication of the strength of return, right? It just tells us how volatile, from a downside volatility perspective, an investment is. But it doesn't give us any sense of the strength of that return. That's where UPI comes in. The calculation is very similar to the Sharpe ratio, if you're familiar with the Sharpe ratio. It basically takes the annualized return of an investment less the risk-free rate of return, so it's the excess return, divided by the Ulster Index, which is the downside volatility. And that gives us a risk-adjusted return, just like the Sharpe ratio, which is the return minus the risk-free rate of return divided by standard deviation. So the difference is that it's focused on downside volatility as opposed to both upside and downside volatility. Again, if you're interested in learning more about that, check out this guide. But of course, in today's age with computers, we don't need to do all those calculations ourselves. We have computers that can do that for us. Two systems that I'm aware of that track the Ulster Index and the Ulster Performance Index. One is Fast Track, which is a tool that I use quite extensively. The Ulster Index is also available on stockcharts.com. It's one of the indicators that they provide. So there's a few resources out there that you can get access to this information. So the question is, before I go there. So in order to get an understanding of how UI and UPI kind of represent themselves when we look at investments, I've put two investments up here. This is a 10-year chart of the S&P 500 and the High Yield Master Index, Master 2 Index. It's the Merrill Lynch High Yield Master 2 Index, which is an index of junk bond funds. Again, you can see they both started at the same place and roughly ended at the same place 10 years later. This was as of a couple of weeks ago when I put these slides together. And I put the risk and return metrics up here so you can see. The return's about the same. The standard deviation, obviously, of the S&P was quite a bit stronger. You can visually see that additional volatility in that line. And the Ulster Index, remember, downside volatility was 6.1 compared to 10.5. So there's much more downside volatility in the S&P compared to the junk bond index. And as a result, the same return, lower UI, results in a higher UPI. So it's got a better risk-adjusted return. Right, so think of UPI as the additional return achieved for each incremental increase in risk that you are willing to take. Right, so it's the additional return you're going to achieve for each additional increase in risk. Okay, so the question now is, how do we use this to our advantage? How do we use this to identify investments that we can put into our portfolio? Let's start by kind of putting up some benchmarks or some guideposts. So I've put up here the Vanguard money market in green and the S&P 500 in red. I assume most of you in this room probably like the volatility of the money market, but aren't particularly fond of the returns of the money market. Is that correct? Amen. Okay, all right. So we'll use that as our bottom post. The red line's the S&P 500. I assume since you're sitting here, if you were an index guy and you were comfortable with the returns and the risk associated with the S&P 500, you probably have all your portfolio in the SPY and you'd be out playing golf or at the beach or doing something else this morning, not here listening to me. So we use that as our other guidepost. So how can we create a portfolio that has more of the risk and volatility components of a mutual, of this money market fund, and maybe a little bit higher return? So I'm going to go through an example of how I would use this. I'm going to use, the tool I'm using is Fast Track, as I mentioned before. And the first step is I scan through the database. There's about 11,000, 12,000 funds in the database. And then I remove all the funds that didn't have at least a 4% annualized return over the last year. So that equated to about 4,400 funds. So that left me with about 7,000 funds. And then I sorted those funds by the Ulster Performance Index. And this is the list that I got. This is the top 18 funds. Again, I'm not sure if you can read that in the back, but you'll be able to get a copy of the presentation. So again, I've sorted by this column, UPI. So what this shows is the symbol, the description, the return for the one-year period, which happens to be the same as the annualized return. And then I've got the Ulster Index, the Ulster Performance Index, maximum drawdown, and standard deviation. So you can see there's some funds with fairly high UPIs, returning anywhere from kind of 5 to 7, 8%. So probably some pretty decent funds in there. If you notice, they're all kind of real estate funds, another real estate income fund, floating rate fund. There's really no equities in there. And the reason why these are scoring such high UPI values has to do with the fact that their drawdowns are so low. So this is over a one-year period, drawdowns of 0.2%, 0.25%. These are from extremely low volatility funds that are producing some really great returns for the level of volatility. So what if we put a portfolio together, let's say we'll take the top 10 of these funds and create an equally weighted portfolio. So we'll take 1/10 of our portfolio and put it into each one of these top funds. Now there's some duplicates here. There's some duplicate share classes of the same fund, so I didn't want to include that fund twice. So I put a red arrow next to the top 10 funds that I've selected and put into my hypothetical portfolio. Now, I'm not recommending these funds. If you guys choose to use some of these funds, I strongly recommend and remind you to check the prospectus. Some of these may have trading restrictions on them, so there may be penalties for trading too early. If you get in and something happens, you need to get out. Some of them may be interval funds that only trade during certain periods of the quarter. So please, 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 I don't want you guys to come back and say, Rob told me this was a great fund, and you find yourself in a situation where you're a little bit surprised. So certainly check the prospectus. So what does this portfolio look like? So the green line and the red line are the same lines we saw before, and now I've added the yellow line, which is this low volatility portfolio, those 10 mutual funds that we selected, and put those together. The return is about 6%, certainly far exceeds the return of a money market. And the volatility is almost non-existent. The downside volatility, the UI, I mean, it's almost the same as a money market. The money market obviously has no downside volatility. That's why the UI is 0. But 0.02 is pretty darn low, especially when you compare it to the S&P 500. It also has a very strong UPI value, and that has to do with the fact that it has that low downside volatility. So you're dividing by a very small number, which really boosts up that UPI. So on a risk-adjusted basis, this is a very strong risk-adjusted return. And comparing it to the drawdown of 15 basis points compared to a drawdown of 10%, you can see the significant reduction in volatility. Any questions on that? That makes sense? You guys are a quiet group.
If you were to have a longer time window, would you have the same composition of the same kind of funds? Would they like if you did 10 years, not 1 year, how would that affect the holdings?
So the question was, what would happen if we extended the time frame out? This is a 1-year period. What if we extended to 10-year periods? Well, it would certainly look different. Some of these funds I don't think existed 10 years ago, first of all. And some of these funds, they do come in and out of favor. Some of these funds that you're seeing in here are a result of the financial crisis. So because there's so many, some of these are mortgage-backed type securities, some of those opportunities didn't exist before the financial crisis and the real estate crisis happened. So you can continue, you can do this type of search that I did on a continuous basis to see what's popping up at the top, and as things kind of fade down to the bottom, you can replace them with better performing investments.
Would you have all those floating rate funds if you did a 10-year? Would you?
The floating rate
Would the
funds?
asset classes be a lot different, or would it be similar?
I think you would see similar. You might see some more high-yield junk bonds in there, potentially. But floating rate bonds tend to be a pretty low volatility asset class. They're somewhat limited on the upside as well, but that's what you get for that reduced volatility. It would look different.
How did you arrive at a one-year look back as opposed to, like he's saying, take 2 or 3 or 5?
I always encourage people to look at multiple time frames. There's only so much I can do in presentation, obviously, but yeah, absolutely. I always encourage you to look at multiple time frames, look at 6-month, year, 2, 3-year, 5-year time frames to get a sense of how did this perform. Let's say in the 2015, we had a little mini bear market, I call it, stealth bear market. How did it perform during that time frame? So yeah, definitely look at different time periods is important. Any other questions? Yes?
Oh, yeah. Do you think the Sortino ratio is better than the Sharpe ratio? And is that something that you look at?
The Sortino ratio is similar to UPI in that it's focused on downside volatility. It's a downside standard deviation, if you will. So yeah, I think, again, as an investor, I'm more concerned about the downside than the upside. So anything that's focused on the downside is certainly, in my opinion, going to be focusing our attention on things that are important to us as investors. So yeah, certainly the Sortino ratio would be another way to do that. Very similar to what we're talking about here with UPI. Okay. What time do I have till?
10:15, 10:20?
10:15, okay.
35
Okay,
minutes?
yeah, perfect. Okay, so with this line, this is a very low volatility, good risk-adjusted returns, but I'm guessing some of you say, well, yeah, that's pretty good, but is there anything else we can do? What else can we do to maybe juice up those returns, maybe take on a little more risk, a little more volatility to achieve a little higher return? So I'm going to shift gears here, and we're going to talk about relative trends and relative strength. So on this chart, I've got 2 investments. One is the iShares U.S. Medical Devices. It's IHI as the symbol. And I have the SPY, which is the S&P 500. Relative strength is simply how does one investment perform compared to another investment? Is one outperforming the other, or which one is outperforming the other? And oftentimes, it's very hard to distinguish that just by looking at a chart. Would you agree that maybe from this time period to the end here that IHI is outperforming SPY? Yes. Would you agree with that? Okay. And here they're probably performing pretty similar, right? The first half pretty similar, and the second half IHI is outperforming, right? So that's what I see when I look at the chart initially. But it's very difficult to do it just by looking at the equity lines. What's helpful is to look at a relative strength line. And while relative strength is dividing, in this case, the red line, the value of the red line, by the green line each day, and plotting that on this chart on the bottom, right? So the value of the red line divided by the value of the green line, and plotting that. And the value that produces is really meaningless. It doesn't have any meaning. What we're looking for is the trend. We're looking for the trend. So when this is sloping up, it means the red line's outperforming the green line. When it's trending down, it means the red line is underperforming the green line. Now, which is interesting, on our last slide, we kind of thought, well, it was kind of similar performance all the way through here, but the outperformer, IHI, actually started outperforming way back here in late December, and actually stopped outperforming about mid-June. So this is the value of a relative strength line. Don't rely on your eyeballs to look at 2 charts and see to be able to tell which one's outperforming on a relative basis, because sometimes your eyes will fool you. But this concept is very powerful if you can identify outperforming funds compared to either another comparative index or to another fund. So good relative strength doesn't always mean positive returns. You can have good relative strength in a down market. So if we look, this goes back to the financial crisis. This is IBB, which is the biotech ETF, compared to the S&P 500. You can see biotech outperformed the S&P 500 for a good portion of this time period. But in the end, they both produced a negative return. So it's important to understand that relative strength is not absolute return. So how can we use this to our advantage? Well, before we talk about that, I need to talk about and just introduce the concept of short funds or inverse funds. An inverse fund is simply a fund that tracks the inverse performance of an index. So in this case, I have SPY, which is the long S&P 500, and I have SH, which is a short fund. It just tracks the inverse of the S&P 500. So if the S&P 500 went up, say 50 basis points one day, we would expect SH to go down by 50 basis points in a given day. And if the S&P 500 went down 1% on a given day, we would expect SH to go up on that given day. Now, we need to be careful with these short funds. There's many short funds out there. They track, many of the major indices, the S&P, the Dow, the Russell 2000, but they also, with the plethora of ETFs out there available to us today, they track all sorts of things. They can track short junk bonds, they can track short real estate, short technology, and even foreign indices. So there's a lot of opportunities out there. The danger with these short funds is that they reset on a daily basis. And so what that means is that over a long period of time, you're not going to get, if the S&P went up by, say, 15%, you may not get the equivalent of 15% on the downside because it's resetting on a daily basis. And you can see that in this chart here. The S&P was up 19.5%, and the SH was actually down 15.7%. So these are really intended for shorter periods of time. So how can we use short funds and relative strength relationships to take advantage of and create a portfolio or an investment that may have some of the risk and return characteristics that we're looking for? So here's the IBB again, and here's the S&P 500. And I've added the yellow line, which is a 50% IBB and 50% SH, which is the short S&P 500. Both of these returned a negative, the red line returned negative 15%, S&P returned negative 39%. But by combining the 50% IBB and the 50% SH, we were able to produce a positive return of 15.7% over this time period. And why is that? And the reason why that is think about relative performance. What relative performance means is that when an investment is, the outperformer goes up, it's going up more than the underperformer. And when it's going down, it tends to go down less than the underperformer. And so if you compare that outperformer with an inverse of the underperformer, you get this much less volatile. I didn't put up the standard deviation metrics. I probably should have added that. But you can visually see there's much less volatility in that line, and it produced a positive return in a negative market time period. So that's one way that you can take advantage of these relative strength relationships. Now, as I said, relative strength is a visual exercise. You need to go through and visually see the slope of this line. Is it going up or is it going down? And so it's time consuming, right? You need to look at a lot of charts. You need to compare a lot of different combinations to find those that are outperforming and those that are underperforming. So it's very doable, it just takes a little effort. For those of you who may not want to spend that much time, there are tools out there available to us today. They're called relative performance rankings. And they're produced by, there's a few places that I've found them so far. Stockcharts.com produces what they call Stock Charts Technical Rank, or Scooter score. If any of you are Stockcharts.com users, you may be familiar with that. There's another website called ETFscreen.com that provides relative rankings on ETFs. And we'll look at those in a second. But all relative performance rankings are is it takes performance over different time intervals and assigns a score to each one of those funds or stocks in the case of stock charts, and then ranks them in a list, and it puts them into buckets when it's compared to another universe. So you can compare the universe, like on stock charts, they compare it to like a large stock to the large stock universe. They'll compare a small stock to the small stock universe, and then provides a ranking. So it'll put the top 10, the top 10% up in between 90 and 100, and so on and so forth all the way down. And so what this does is, instead of having to look at individual combinations of funds against a bunch of different comparative indices, it provides a easy snapshot, an easy way to get access to this relative performance. So it's actually very handy. Each site has their own methodology, and they don't always share all the details of those methodologies, but from what I've found and what I've studied, they tend to work pretty well. So let's take a look at stock charts. Stock charts, so all this is a listing from stockcharts.com. It's the symbol, the name, and then you've got the Scooter score. This is what I mentioned before. This is the Stock Charts Technical Rank score. So this is their relative performance ranking. And I've just taken the top dozen or so off of the list, and these are all ETFs that I screened off of. And there's a couple of ways to use this. One way I like to use this is just to see what are the top performing sectors at any given time. So here you can just go down here. It's like healthcare. This is a biotech innovation fund. Financial technology. This is an interesting one. This is a new one that's popped up. MJ, anyone